Welcome to NACD BoardVision, where leading boardroom advisors, governance professionals, and seasoned directors discuss critical issues related to your responsibilities in the boardroom.
Hi, I'm Steve Kalan. Welcome to BoardVision. With me today is Jane Romweber of Meridian Compensation Partners. Welcome, Jane.
Hi, thanks for having me.
Analyzing lost say-on-pay votes is our topic today. Last year we saw that 44 companies received less than majority approval of their say-on-pay resolutions. We've seen even more failures in the 2012 proxy season, with at least 50 companies already in the same boat. Jane, what are the key things you advise boards to do to avoid that result?
At Meridian, we've analyzed the failed say-on-pay votes from the 2012 proxy season and conclude there are easy answers and not so easy answers to winning the say-on-pay vote. There are two things that will have the greatest impact. First, have pay opportunities, particularly the CEOs, that are moderate in size, meaning near the size-adjusted median of comparable companies. Second, tie a large majority of incentive pay to specific, rigorous performance goals rather than just continued employment.
What about some of the current hot-button issues, such as corporate jets and tax gross-ups?
They're important as well. Companies that still see a need to include some of these red flag items in their programs should be aware they may be perceived negatively by shareholders. Those companies may need to have even more moderate pay levels and a higher proportion of performance-based pay if their programs still include things like significant perks, above-market severance protections, change in control single triggers, tax gross-ups for excise or income tax, or special executive relocation policies.
Most CDNAs are now written to address ISS's concerns, sometimes even mentioning the proxy advisory firm in the executive summary at the beginning of the CDNA. While there are other proxy advisory firms, wouldn't you agree that ISS is definitely the most influential?
Yes, their impact is significant. An analysis of shareholder votes suggests that an ISS against recommendation lowers approval percentages a hefty 30 points. Fortunately, only about 15% of those companies with an against recommendation actually lose their say-on-pay votes, but even that, as you noted, has resulted in 50 failures so far this year. It's also worth noting that all but one company failing say-on-pay votes so far this year had an ISS against recommendation.
Jane, let's take a deeper look at some long-standing executive pay practices that ISS is calling into question and how that's affecting say-on-pay votes.
Sure. Let's start with the common situation where bonus is paid for achieving the earnings budget for the year, and it so happens that share price growth has been negative. This is fairly common, especially in cyclical industries. ISS's tests favor situations where lower stock performance is accompanied by lower bonus payouts, even if earnings are strong. But since bonuses are generally based on financial performance, and especially earnings, rather than stock performance, ISS's methodology presents a problem for any company having a poor year in the stock market.
We're also hearing a lot from our members about ISS-defined peer groups versus peer groups defined by companies. ISS uses Global Industry Classification Standard, or GICS codes, exclusively to develop peer groups. By contrast, many of our members use companies in comparable, but not identical industries, and may also consider such factors as complexity or location. So we sometimes see large mismatches between peer group pay ranges.
That is a big issue and a frustrating one for many companies because ISS doesn't give much ground there. Another issue is how companies are positioning their pay against the market. ISS pushes back in situations where companies position their executive pay opportunities above the 50th percentile when their stock performance is average in comparison to their peer group. But for a company to immediately move its pay target down, say from the 75th to the 50th percentile, could require draconian pay adjustments, and companies may have had substantive reasons for targeting pay above market median.
What are some of the deciding factors that can cause a plan to receive a negative ISS vote and a failed shareholder vote?
We can't really pinpoint deciding factors, but we can see trends and patterns in the ISS reports for companies with an against recommendation that also had a no vote from shareholders. A few we've seen that I haven't mentioned already are 1. Grants that appear opportunistic, such as an extra off-cycle stock option grant at a very low stock price. 2. Paying discretionary bonuses not based on pre-established goals. 3. Goals and performance-based plans that are viewed as not rigorous. 4, CEO base salary increases when base salary was already well above market. And 5, high non-performance-based pay via retirement benefits, deferred comp arrangements, or perks.
Jane, as you've said, there are many situations where ISS recommended against a company's executive pay plan, but it passed anyway. ISS has recommended against roughly 14% of plans, and obviously far fewer than that have failed. So let's look to what companies are doing that is positive.
Yeah, let's flip the list that I just went through. So, number 1, stock grants that are awarded based on performance and that have long-term restrictions. 2, formulaic bonuses based on pre-established goals. 3, goals and performance-based plans that are viewed as rigorous, perhaps when compared to the prior year's actual results or the performance of similar companies. 4, recognition that salaries are above market by holding them flat. And 5, low or negligible retirement benefits, deferred pay, or perks.
It's important to note that even though these say-on-pay votes are strictly advisory, companies are spending significant amounts of time, energy, and money to avoid failing. Tell us what Meridian hears from boards as they build their compensation plans to avoid these negative votes.
From a reputational perspective, no board of directors likes having aspersions cast on its decisions in a public forum, nor do executives like to be viewed as overpaid. And from a more concrete risk management perspective, about 25% of companies failing the say-on-pay vote last year were subsequently sued. Even if the suit is unsuccessful, and many already have been, a successful defense takes additional management and committee time and expense.
Thanks, Jane, for talking with us about this year's results on say-on-pay. We're already seeing companies adapting their pay programs and shareholder communications to suit this new environment. Until next time, I'm Steve Kalan with NACD, and this is BoardVision.